Good afternoon, everyone. Today I'm chatting with Simon Marcotte from Northern Superior. Folks, Simon is coming off the back of another acquisition of a company he was CEO of, where he's taken it from concept all the way to a successful exit. So we get into that transaction. But the big reason I'm excited about having Simon on is because he is great at breaking down where gold is heading and giving us his reasoning for why he thinks that right now we are in the early innings of a path that's going to take us to $30,000 gold. All right, everybody, enjoy the interview. Simon, it's great to see you again.
Good to see you, Steve. How are you?
So you have been one of the more bullish people we've talked to about the price of gold. You came on our program around a year ago calling for $30,000 gold. For us, that video got tremendous traction. Lots of people were listening to the words that Simon had to say. Now, we're at a point in the stock market where everybody's talking about this AI bubble, where we've got all these companies, NVIDIA, Oracle, OpenAI, they're all basically doing transactions amongst each other. People are saying that, well, this is effectively creating a whole capital misallocation, mismatch type scenario where we don't know what's real anymore. Headline after headline saying that this could be, we may have seen the top of the market for now, at least as 10 companies dominate the S&P 500. So what are your thoughts on what's happening right now, and how does this tie into gold?
Yeah, well, thanks for having me on, Steve. Always a pleasure to talk to you. Yeah, so I mean, gold has been doing well, but we've had a bit of a pullback in recent months, and I think we need to remember why it's called the bull market, right? Because it's going to shake you off its back sometimes. So you need to hang tight. But yeah, to your point, I did call for a $30,000 gold. I don't want to dive into that once again, but it is playing out as expected. It is now pretty much a slam dunk that the real rates will drop and will drop aggressively. And if you look at the free cash flow of the gold companies, it went up by more than 10 times. If you look at the stock price of the companies, they went up by less than 3 times. So there's still a lot of catch up in valuation to do. Now, in regards of the market, the everything bubble that culminated into the AI bubble, it is a bubble. The question is, will it burst? And when? And my take on this right now is I believe that the Fed will want to reflate the bubble before it bursts. And I'll come back in a minute as to why. Now, as far as will it burst or in the foreseeable future, I look at two things. So first, I look on one side at all, the fundamentals of the equities, the sentiment of the equity market, and on the other side, the money flow. And obviously, either of those things can pop the bubble. So first, if we look on the sentiment and the fundamental, sentiment and the fundamental do support a bubble pop. First, if you look at the valuations, to your point, there's a lot of vendors financing, right? Financing between companies and selling to each other and all that. So when you have these situations, the same way you had in the 1990s, it is to look at a free cash flow multiple. So you exclude these equity investments and all that, and you're almost at the same same multiple that you were in the tech bubble. You also, I'm sure, have seen the Buffett indicator, which is the market cap of the market versus the GDP. At the tech bubble, the peak, we were at 150%. We're now at 225%. You can also look at the CAPE ratio, which is the adjusted cyclically adjusted P ratio. You're about at 40 times right now. The only time that it was higher was during the tech bubble at 44. In 1929, it was only 32. So valuation wise, definitely supports a bubble pop. And then there's the sentiment of the companies. Steve, the last time I was on, I think 6 months ago or something, I did mention that in the gold space, when we had seen a change in market sentiment to M&A, i.e., when you would see company A buying company B, the stock of company A would move up. So that definitely changed the conversations into the boardrooms of the gold companies. Well, the same applies also for the AI world right now. Just the day before Halloween, right? Facebook Meta announced a big investment into AI, and the morning after, the stock sold off and been selling off ever since. So that may change also the discussions into those boardrooms about how aggressive they're going to want to get. And then another thing that I saw that I thought was interesting is Qualcomm, right? Qualcomm spiked, about 2 weeks ago when they announced that they came up with their own GPU. Well, that's good for Qualcomm now, but if everybody starts coming out with their GPU, then those products are going to get commoditized, and if they get commoditized, then the margins start to contract. And for a growth stock, when you see the margins contract, most of the time, it's time to sell. So all that for sentiment, fundamentals, and all this, I think we're looking at a bubble that could pop. Now, doesn't mean it will, because you can't ignore what I call simply the money flow, right? The bubble of the 1990s was very different from the bubble that you're seeing now. The bubble of the 1990s, the tech bubble, was driven by the fact that the U.S. government didn't have a deficit anymore. It went into surplus, as crazy as it sounds today. So the economy every year is creating wealth, and every year the federal government takes a bunch of that money off the top to fund its operations. So when the government was not taking that money every year anymore, that wealth needed to find a way somewhere to go, and it went into the tech bubble. It's actually when Greenspan started to increase rates 3 or 4 times that it slowed down the economy just enough so that the bubble popped. So that was the story of late 90s, early 2000s. Now the bubble is being driven by the exact opposite. It's being driven by very large deficits that are being monetized by the Fed. So I think you can understand that it's a lot easier to run big deficits than it is to run surpluses. So definitely this bubble can last longer, and deficits are going up. So the money flow does not support a bubble pop. We may see a lot of volatility, but the money flow, looking at it like that, it doesn't support a bubble pop. It supports a currency devaluation, though, right? Which is very good for gold. Now, I said earlier that I think the Fed may want to reflate this bubble before it bursts. So here's what I mean by this, because we have seen a major change in the way this economy works. And it's the fact that the consumer is now driven by asset prices. And that's major, right? Like the consumer has been driving the US economy for so long. I mean, I remember even in the late 90s, people were saying, hey, at some point, the consumer is going to give up. And then it just kept going for decades. And for the longest time, starting in 2001 with the tech bubble, especially, the interest rates were going down nonstop. So the consumer was being driven by credit expansion, right? People would get a line of credit on their home. They would spend the money. When that money was spent, they'd go back to the bank. Price of the house went up again. They'd get another line of credit, spend that again. So lower rates, credit expansion, consumer was being driven. That started to change in 2008 with the GFC. In order to relaunch the economy, Bernanke launched the what he called he wanted to see a wealth effect. So since then, we've been seeing a transition from the consumer being driven by the credit to the consumer being driven by asset prices. And since real estate has pretty much plateaued, it's all about the stock market. So what I'm looking at is go back to basics here, right? What is the GDP? The GDP is obviously government spending, the consumer, investments, and trades, right? Investments is all AI now. As crazy as it sounds, the AI investments is the same size as the consumer for the GDP. So what I'm saying is, if the AI bubble bursts, then both investments and the consumer are gone, and you only have the government and the trades to sustain the GDP or to support the GDP, and we don't want to trade. So you'd be left only with government spending when you already have a deficit and now a debt problem. So I think that the Fed will want to avoid this bubble pop at any cost. I mean, let me put it another way. If the bubble of everything bursts, there's nothing left, right? So all in all, it's not a slam dunk that this bubble is gonna burst. It could happen, it could not, but I mean, I wouldn't bet on it. I would bet on gold instead, right? Um, and just to finish on the macro thought here, when I came up on your show saying I think gold is going to go crazy and it's going to be like $30,000, that is based on the idea that President Trump wants to put in place wartime financial conditions into this economy. And this means negative real rates, where inflation is obviously higher than what you get in as interest rates. So when you enter this type of period, it's obviously very good for assets, right? But it's very bad for cash and bonds. And last time that happened for a prolonged period, I mean, it did happen for a very short period at the beginning of COVID, and gold stocks went crazy, if you recall. But for a long period, the last time that happened, it was in the 1970s, and people were screaming. Obviously, people made gold investors did very well, but generally speaking, the population didn't like that at all. They were screaming. But I think we need to realize that in the 1970s, the bond market was many, many, many times larger than the equity market. Now the stock market is almost the same size as the bond market. So it's not going to hurt as much at all now, right? And in fact, the only people are going to get really, really hurt by this would be, unfortunately, poor baby boomers. The rich baby boomers own a lot of stock, the poor ones don't. So yeah, I think a prolonged period of negative real rates is not only unavoidable because of the current debt level, it's also being triggered by the policies. But lastly, it's doable. I think unlike the 70s, now it's actually doable. So I think it's in front of us. When the real rates do come off, I think we're going to see gold and gold stocks as the next bubble. Simple as that.
So something I've been exploring the last few days is this idea that when we think about big tech, whether we're trying Nvidia, Google, Amazon, etc., there's certain names that retail investors flock to. You turn on CNBC in the morning, they can't stop talking about, they've got that handful of names that is the focus. You think that we're going to get to the point where some of the major gold names become synonymous with large retail followings and they can kind of take on those huge premiums of their own? Say, to word the question differently, do you think we could get to a point where people look at Agnico Eagle like the Nvidia of the gold space?
Yes, I think this is exactly what's going to happen. And if you look at the Canadian investment landscape, I would go as far as saying that in the years ahead, we may see a situation where all of the dividend mutual funds and dividend funds out there, which is a huge pool of capital, will have Agnico and other gold companies as their top holdings over and above. Now it's always, the TransCanada Pipeline, TransAlta, and that sort of thing. I think gold can replace those names into the pole positions of the dividend funds. At that point, I'll say maybe it's time to get out. But right now, I think the game has yet to start.
So obviously it's great to talk about the bullish part. We've got a huge audience, people who invest in gold stocks. Something I was thinking about the other day is what would break the gold trade? What would have to happen for you to not be as bullish on gold as you are right now?
Oh, there's plenty of things that worry me every morning. And what worries me right now is the fact that the Chinese are restarting QE. And people tend to say, well, it's more QE, it's good for gold. Remember 2012? It's when Japan started to do more QE that it kind of triggered or established a peak of the gold price at the time. Because yeah, it's more QE in the long term and all this, but in the more short term, it supports a higher U.S. dollar and it unwinds that trade. So I think the Chinese QE is one thing. Then the other thing that worries me is the Japanese rates. Just 2 weeks ago or last week, we saw the rates in Japan kick up quite a bit. To a point now that a lot of observers are calling for the simple end of the carry trade once and for all. If that would be a heck of a tsunami that would come, and that could hurt in the short term. But if that does materialize, the Fed's going to step in to stop that tsunami from hitting the shore, and that would be extremely bullish for gold. So, like I'm saying, a bull market is going to shake you off its back. Expect volatility. Those are tectonic plates that are moving from an economic perspective, so it's not going to go up in a straight line. But I would hang tight because I think you're going to turn around 5 years from now, and you're not going to believe you were worried, in 2025.
As an investor, where's the sweet spot today? Are we talking producers, developers, early stage explorers? If you are looking for a bit of torque, where should you be looking to invest right now?
I think it's a stock by stock, and you want to have exposure, I think, to all of the above. I think if the macro trend ends up being that strong, so there's not an obvious way or an obvious reason to be overly aggressive. So I would definitely have the good producers, but let's not forget the real money that you can make is when penny stocks go crazy, and to see 10, 20 times your money into that space is really not impossible. So I think you need to be involved into all of the above.
One other thing I want to get into before we get into the recent transaction is the major projects office in Ottawa. Mark Carney is pushing forward sort of a new office that is designed to streamline and help find financing for mining projects and resource development in Canada. They've announced 11 projects so far, five of which are mining. One is a transmission line to a mine. So it seems like it's positive stuff, but I'm curious. I know that you are pretty well read on this stuff, and you have recently completed well, or in the process of completing a pretty um, uh, big merger in the gold space. When you read about what Carney is doing with the major projects office in Canada, do you think that this is real substantial movement, or do you think that this is just optics?
No, I think it's real, and I think it's real because it has to be real. um, I think the reason why President Trump is constantly attacking Canada has nothing to do with Doug Ford's advertising on TV. I think it's more fundamental and very simple. The Trump administration has a pretty bold and unusual playbook driven by Stephen Myron, who now has joined the Fed. And clearly, they are looking to weaken the US dollar. And they've been very successful at doing that since taking power, as you know. Well, I can't help myself but to think that if that's part of their playbook, they don't want the population, the Americans, to realize that their U.S. dollar is evaporating in value. And I would think that if you ask most Americans, they don't really know the exchange rate between the US dollar and the Mexican pesos. I would bet that they don't really know the exchange rate between the euro and the US dollar. But most of them are going to know, yeah, the Canadian dollar is about 25% cheaper than the US dollar. So if you put in place policies that are very negative for the US dollar, and the Canadian dollar goes up, above par, people are going to start asking questions. So this is just a theory of mine, but I believe it's for that reason that Trump is constantly attacking Canada and finding any excuse in the book to do it. So we need to respond from that. And the Canadian economy is in a very particular situation where it kind of need to have the same type of monetary policies and fiscal policies than the U.S. We can't really have some policies that are so different than the U.S. because then it's going to distort trades, although trades are going down. But there's need to be support from the government, and when I look at the investments that they want to make and when they want to support, I mean, I know nothing about the other projects that's outside of my expertise, but if I look at the mines that they're looking to finance and to support, they are very, nickel, Canada nickel. You know very well what's happening in Indonesia. If you're going to build a new nickel mine, absolutely you need some government support. And guess what? Over the next 10 years, of course, at some point, nickel is going to come back. The world cannot rely on Indonesia. So I think that's a smart move. Same thing, the second mine is Nouveau Graphite in Quebec, which I know very well. Well, graphite is extremely difficult to commercialize. And I think Nouveau Monde is the only company outside of China that's been successful at putting an offtake agreement with a battery maker, being Panasonic, but they needed a bit of support for the rest of it. So the Canadian government guarantees the support and then has a deal to resell to companies in Germany, which is exactly the same deal that the U.S. did with MP Materials. So I think it's good. It's timely. It's at the right time. The right thing to do. I'm definitely a supporter of these investments.
So let's talk about your recent transaction with Northern Superior and IAMGOLD. First off, congratulations. I was surprised at how quickly this came about. It seemed like just yesterday you're kind of in the early stages of this, and now we've seen that vision of consolidating the camp to exit play out really fast. So, how did this specific transaction with IAMGOLD go from idea to first conversations to ultimately a signed deal?
Well, the circular is now out, so you can read the background of the transaction in the circular. But I think it's fair to say that we both looked at the camp in the same way. Both IAMGOLD and us and everybody else in the camp just concluded that this needed to come together. And I think it's the right time as well for IAMGOLD to do it now that they've got Côté um, doing extremely well. I mean, if you saw their Q3 was unbelievable. And also they have a whole team that is from Quebec, right? I mean, Renaud Adam, now the CEO, I mean, he's repeatedly proven as exceptional operator. And I mean, he did Island Gold of Alamos, that is now owned by Alamos. That was a Richmond mine, and now I think that's the best performing mine of Alamos. Then did a very good job at New Gold, and now came in into to for the ramp up at Côté, and the execution has been very good. So he's from Quebec. Bruno Lemelin, his COO, is from Quebec as well. So it's a whole team that is perfectly put together to build something big in Quebec, and putting that whole camp together allows to look at much larger size and much larger production levels, and that can be a major operation in Quebec and going forward. So it was nice. It was nicely done. But how did it come about? I'll invite you to read a circular for it.
Okay.
Okay.
So you in the past have called the Côté mine one of the most strategic gold assets in the world and argued that the Chibougamau camp can be a 500,000 ounce producer. Now, if we're thinking about it from IM Gold's perspective, and I apologize for putting you on the spot here and asking you to speculate a little bit, but do you think that the strategy there is that they're looking to create assets for those major producers that are focused on tier one projects and are going to be looking down that sort of list of companies that make sense to acquire? In other words, do you think that IAMGOLD is shaping up to be a name that sort of the Agnico Eagles and the Newmont and the Kinrosses and those larger companies are going to be looking at with a twinkle in their eye, saying, "How do we approach this?"
100%, Steve. I mean, we didn't sell our company to IAMGOLD for no reason. We see an enormous amount of value in the equity of IAMGOLD. Now, to be clear, I don't know anything other than anyone else, more than anyone else, in regards of IAMGOLD. But what you just talked about, the strategic value of IAMGOLD, is the most speculated topic on Bay Street, and I would certainly sit on the side of the school of thought that this is too appealing as a company not to at some point being acquired for a few reasons. I mean, first of all, Canada is the most strategic geography now, right? For the reasons that we just talked about, the Canadian dollar is pretty much the only currency in the world that's been underperforming the US dollar over the past 10 months. So if you're producing gold in Canada, your margins are absolutely unbelievable right now. So Canada on its own is very, very strategic. Now, from more a micro point of view, if we're going to talk about Canada, we can't we cannot not talk about Agnico. I mean, Agnico controls Canada, and they probably don't want to lose that, right? So if you look at Canada and who are the biggest mines, Detour is the largest mine, right, at about 700,000 ounces. That's Agnico. Then you have Canada Malartic, about 600,000 ounces. That's Agnico. Then you have Meadowbank at about 500,000 ounces. That's Agnico. Then you have Meliadine, about 400,000 ounces. That's Agnico. Then you have Côté Gold, IAMGOLD, at nearly 400,000 ounces. And then you have Macassa, 300,000 ounces, Agnico. And then you have LaRonde, 300,000 ounces, Agnico. Well, guess what? I think it would make sense if Agnico wants to keep its grasp and I should even say control on Canada, that Agnico would want to own IAMGOLD for a few reasons. I mean, first of all, if you let another major buy IAMGOLD and enter Canada, well, the next time there's going to be a mine like this up for grab, you're going to face real competition, right? But in the more immediate term, if you let another major enter Canada, that's likely to put pressure up on the labor cost, right? Because staff tend to start moving when that happens. So, I think it's a no-brainer for Agnico. I even think that Agnico is probably waiting to see what's going to happen with IAMGOLD before they buy other stuff. But in my mind, there's no doubt that Agnico will do something at some point. If they're not doing anything, then where's my dividend, right? they're getting what, 1.7 billion a quarter or some crazy numbers like this. So I think it makes a lot of sense to expect something to happen with IAMGOLD, but Agnico is not the only one. There's a lot of other companies that for who it would make sense as well. You saw what Elliott Investments is doing with Barrick, talking about splitting the company and having a company focused on safe jurisdiction. That could be interesting into those discussions. So I'm certainly of the side that of the group that will keep its shares of Northern Superior, keep the shares of OnGold of IAMGOLD for the foreseeable future. Great way to play the gold market.
Well, Simon, last question for you. You've been generous with your time, and it's always a pleasure when you're on here. But I got to ask for Simon Marcotte, what's next? Are you going to hop on the board or something of IAMGOLD and get involved there, or you're kind of done with the Shabugamu camp for now? You've got a history of transactions here. I have a list of them in front of me where you've started out with something and it's worked its way into a clean exit for investors. Arena with Lithium Americas, Royal Fox, Mason Graphite. You've got a pretty nice history. What's next for Simon Marcotte? What's the plan?
We're certainly have working on a few ideas right now, but I'm not going away, Steve. Don't worry. Well, we're definitely working on a few ideas, and when we're ready to end on something, I will be back on your show.
You gonna stick around in gold? You think?
Yeah, definitely. But we also are starting to see quite a bit of value into other commodities, right? I think, frankly, I think we should look at lithium again. Even though those cycles are quite short, they can be quite aggressive. Um, and we're starting to well, the market is moving from a deficit, from a surplus to a deficit, right, next year. I'm not saying lithium stocks are gonna go crazy next year, but over the next 5 years, yeah, I think it'll come back. So probably a good time to put something together. But as you know, I think this is just the beginning for the gold cycle. I think it's the next bubble. So no, it's not time to retire.
All right. Well, Simon, thanks again for hopping on, and hopefully we can sit down and do this again in the new year.
We will. Thank you very much.
All right, everybody. Thank you for watching. If you enjoyed this interview, do me a favor, smash that like button, subscribe, and ring that notification bell. Also, if you want more mining content, check out our website over at thedeepdive.ca. Thanks for watching, everyone.